I found a huge anomaly in the economy right now, and I want you to know exactly what that is. In today's video, we are going to talk about that anomaly first. Then we're going to look at debt going out of control. And also, we need to talk about how the energy crisis is entrenched. All of that will be discovered here. If you stick with me in this video, let's begin. Retail sales in September fall flat. You may have heard about this, but I wanted to show you it as a lead up into this anomaly that I've seen. Retail sales in September were a mixed bag, suggesting that while consumers haven't stopped shopping altogether, inflation is starting to make them less inclined to open their wallets. I would have to add this very important point that people are still spending, but they're doing so on their credit card and they're buying everyday items. They're not out there buying the things that they really don't need. They're using it for their daily purposes, and that is a warning sign. So of course, if prices are rising, they're still spending the money, but it's what they're spending the money on. Then we look at this. Morgan Stanley says jaw-dropping inventory levels a key risk to retailers. I need to look at this article in depth, and I will cover it very quickly for you. There's a 19% discrepancy between inventory levels and sales growth. So I'm going to show you what this is all about today. This comes from FreightWaves, one of my favorite resources to use. A Monday report from Morgan Stanley's equity team said that inventory is a key risk to retailers and electronic goods manufacturers, thanks skidding demand amid a glut of inventory. That's the first object right here. We need to understand inventories are climbing and there isn't that demand. Part of that came last year and the year before, where there wasn't enough stuff. Getting the stuff onto those ships took so long. It was so expensive. So now you had businesses ordering 5 times as much, 10 times as much as they would need, thinking, I better order all this stuff now because I'm never gonna get it. So they did so. And then you run into an issue. Imagine these retailers are ordering stuff from the summer or for the summer. It doesn't get there until late in the summer. People have already looked around elsewhere. Now they have to clear it out. So that's what we'll discuss more in detail. Here you have the example that they use, Best Buy, Gap, Williams-Sonoma, as most exposed to these inventory risks. In the goods industry, Morgan Stanley said there's a 19% discrepancy between the inventory and sales growth. This should be not just for people who are looking at, is this a good company to buy? Is this a good company to short? But also on another level, what happens to these businesses when they've got too much stuff, their sales start to slump? That's right, they start to lay people off. Okay. Companies with high consumer exposure have slashed their ordering, even though this time of year tends to be when retailers are beefing up their warehouses ahead of the holiday season, something I've talked about many times over. I'm in the industry, e-commerce, and when you're moving stuff overseas, Q4 is tough. Number one, freight rates are usually going up during this time. It's going to take you a little bit longer to move this stuff across, and always having the competition there. Okay. Now, it seems like it's the opposite. It's odd. At least that's my experience, and now I get the data behind that. According to the Morgan Stanley Shipper Survey, in which some 100 corporations regularly share their transportation needs and macro expectations, net ordering levels have reached the lowest point in the survey's 12-year history. Ordering levels are 40% down year over year. Net inventory levels remain unusually high. All of this stuff together is basically what I've been talking about all along. But now we have the data to actually back it up. Almost half of respondents say that their inventory is higher and ordering is lower going forward. What does that tell you? They don't believe that Q4, a big time normally, is going to be hot at all. Okay? It's indicated over inventory and destocking conditions. This just shows you that we are in for some odd circumstances, at least compared to previous years. Faced with the glut of inventory, companies will need to decide whether they want to accept high costs to continue holding inventory, destroy inventory, by the way that happens, believe it or not, keep prices high and take a hit on the number of units sold, or slash prices to stimulate demand. And I'll talk more about that in a few minutes in the split screen. We believe many will turn to aggressive discounting to solve their inventory problem, which is likely to spark a race to the bottom as companies attempt to cut prices faster than peers and move out as much inventory as possible. This dynamic will weigh heavily on margins and fuel earnings slowdown that we are predicting. Big deal right here, okay? And I just wanted to highlight that for you as we move into this. Services inflation takes over. Rising prices can often lead consumers to switch their spending to other things rather than cutting back overall. Didn't I say that a few minutes ago? Absolutely. Right now, for instance, Americans are switching more of their spending from physical goods to services, and that shift is evident in the categories where prices are rising. Most people in America spend pretty much their whole budget anyway. You know how it is, right? Paycheck to paycheck. So the money's going to get spent. It's just a matter of where it's going to get spent on. And I have talked about this over and over again, and it's important that we really highlight this. Where is the money being spent? Which companies are most at risk? And what's going to happen here if this continues? What is the trend? We'll talk more about that here in today's video. You could see in my opinion, one of the most important charts right now, and that is your real average weekly earnings. When you factor in inflation, what happens here? Well, month after month after month after month, pretty much all of 2021, all of 2022, this has been in the negative. People are losing out each and every month because of the inflationary forces. So let's break this down right here. You could see where the sales are going. The US consumer is the most important factor to the US and by extension, global economy. We know that 70% of the economy is based on the consumer itself. When debt is cheaper, people borrow more and they spend more. People know that, right? When debt is more expensive, they spend less and they borrow less. It's pretty simple to figure this out, but what does that mean? Inventory has been piling up so rapidly that we are seeing this directly at the retailers, and that has been shown at various companies, including Walmart. Less shipments are coming through. You're seeing that with imports right now today. Sales are needed to push inventory out quickly. So all of these things, just breaking it down to make it known that we need to really understand that it's not the businesses that we should be shedding a tear for. No, nobody's going to be crying for Walmart. But what we need to realize is that these companies are starting a daisy chain effect, a domino effect, where one company starts to lay people off, the rest go in line. All these CEOs are talking, all the businesses are basically going to be influenced by one another. They're going to lay people off if this is the case. If there is, in fact, demand destruction by increasing interest rates, well then, we do have an issue. And this is all because of what's happening with the cycle of interest rates. Okay, I'll try to talk about that more in a second. Let's break down further what we've got today. So right now today, you can see that US interest rate hikes are moving at a very fast pace. Historically, this is still way too low. That's something that they're not really breaking down here, but just the fact that we have seen incredible difference in between where we were at 0%. Look, anything looks higher than zero. So we see it from that perspective. And of course, it is significant, and that has a dramatic impact on people's ability to borrow, therefore spend. We're seeing buyers backing out. This dramatic chart reveals the U-turn in the housing market as sellers slash home prices. We're noticing this in some areas more than others, but of course they have to slash those prices because we're not in that crazy world anymore. Flipping over to the UK, 6% on your mortgage rates is going to have a dramatic impact on people's ability to buy homes, right? Contrary to a great deal of popular opinion, the main driver of UK residential property prices is not supply and demand, nor changes to stamp duty rates or restrictive planning rules. And this is something I talked about over and over again, okay? Instead, Simon French is a chief economist. UK house price inflation moves closely with that of the wider G20 group of countries, which indicates that it's the, quote, global financial cycle that is doing the heavy lifting in determining prices. So, in other words, it's the cost of servicing a mortgage that's important rather than domestic policies. So what am I saying here? It's the fact that interest rates rise. When interest rates rise, it slows everything down. When interest rates go lower, it speeds everything up. And that goes with purchases of risk assets, but also the economy in general. I've highlighted this 1,000 times before. In fact, if you want to see a really fast video, you type in the money GPS, all one word, 40 seconds, and it will tell you in 40 seconds exactly what's going to happen in the stock market. I'm telling you, that has been extremely accurate. Strikes, possible blackouts, and plunging currency. Brits are being hit by a wave of bad news. So we're seeing this right now with the UK, but understand that this impacts real people and it's so many different angles that you cannot rely on simply one factor. Don't listen to those people, this is it. Only look at this one thing. No, we had to see it from all sides. Saudi feud leaves the US asking if relations are beyond repair. I have highlighted this over and over again, particularly recently, how Saudi Arabia is starting to get real friendly with China. And that's important because you've got the BRICS alliance and other countries are saying, hey, can we take part in this whole BRICS thing? So we've got a big change. And of course, if they start to price their oil in something else other than US dollar, oh my goodness, this is going to be a big change on the global scene. Okay. Europe's deepening fertilizer crunch threatens food crisis. This was back in late August, but I just want to highlight this because it shows us that this is still an existing problem while the prices have come down from their peak. I think it's important that we look at certain parts of the world and how they are dramatically affected by what's happening with Ukraine. And of course, that is an issue. People are going to be paying more for their food and even finding certain things hard to come by. US heating costs expected to tick up this winter. Of course, that's just the way it goes. It's not just Europe. That's the whole thing, right? If we're going to be getting hit from one place because of energy, maybe we'll get hit from this side because of food. It's all going up, and that means people will spend less. The most used energy sources in Europe, if you wanted to look at this, I just found it to be really interesting. So you could look at different places that use a lot of natural gas, for instance. Most of that might be coming from Russia. So they're going to be hit by that. And other places that are using coal, are they getting it from Russia? Are they getting it from Australia? Are they getting it from Poland? Where are they getting it from? So let's break it down on what's happening with the energy crisis because this is really unraveling, okay? Inflation has accelerated and hasn't been stopped by rate hikes so far. Imagine, they've gone this far, still haven't had an impact, it seems like. Fed President Mester said 2% inflation rate will take years to get to, suggesting that interest rates will remain higher for longer. People are saying, yeah, don't worry, it's going to end soon. They still have to remain elevated for a period. People must get used to paying higher prices for food and energy as these issues are now entrenched in the system. And that's just the way it goes. I'm just trying to be the messenger, okay? Can you seek out a reliable source of food? Local farmers, buying non-perishable goods in bulk, whatever. You need to do these things for yourself, okay? Call your providers and ask what's available. Don't just talk about it. Don't just search what has happened. You've got to make the phone calls. Actually do the due diligence. Call them up and say, can you give me a better deal? Do you have a promotion? What is available right now today? And those phone calls are going to make a difference, okay? This is so important right now. We must understand what I call the pillars of prosperity, and everybody should be paying attention to them because there are two avenues for you. And I think that if people take either one or the other or do a bit of both, they're going to be better off. And what does that mean? Essentially, you can have a scalable business or high income skill. That's one aspect. Or you can have the self-sufficiency and preparedness. Either way, people can feel like they are actually prosperous. They're going to get that prosperity because If you got your belly full, you got a roof over your head, you're going to be good. You're going to feel good. And that's really what it comes down to. Okay. So I want to thank you for being here today. Did you enjoy this video? If you did, you're going to really enjoy tomorrow's video. Okay. Because I'm going to get in more depth. I have like 47 tabs that I didn't even get through for this video. So you want to do that. And all you got to do is hit that subscribe button. See you tomorrow.